Okay, everyone, we're ready to get started here. Can everybody hear me okay? I know you can't nod, so I'm just going to assume that you can. Welcome to our first webinar for the Blockchain Research Institute. For all of you, just a quick reminder, the Blockchain Research Institute is a multi-million-dollar initiative, the largest of its kind globally, conducting the definitive investigation into blockchain opportunities, strategies, use cases, and challenges focused at business leaders, government leaders, and leaders in other institutions in the economy and in society. It's an ambitious project. We've got together over 40 projects which we'll be launching over the coming months. Currently, there are 25 research fellows and research directors who have joined the program to conduct investigations in everything from financial services to retail, manufacturing, and accounting, and also looking at some big questions that I think a lot of people are asking right now. How will blockchain interact with other technologies of the fourth industrial revolution, the Internet of Things, AI, quantum computing, and the like? Our first webinar, naturally, is on financial services. It's called Blockchain and Reinventing Financial Services. We said in the book, Blockchain Revolution, that within 5 years the industry would be basically unrecognizable, and we were only half right in that regard, because in some respects it's happened a lot faster in certain parts of the industry in only a year since the book came out. Together we've got a terrific group of panelists: Ashish Birla, the VP of Product at Ripple, and Matt Spoke, the CEO of Nuco, two innovators in their own right who are doing some pretty pioneering work in helping to accelerate adoption of this technology. So the way it's all going to play out today is I'm going to allow the two other members of the webinar to introduce themselves, after which we're going to start engaging into a bit of a Q&A, and from there we're hoping that you'll begin submitting questions as well so that we can make this interactive, because in the end it's you that we want to hear from. It's you we want to know how you feel about this and what you want to know from the panelists. So without further ado, I will kick things off. I'm Alex Tapscott. I am the Executive Director of the Blockchain Research Institute and the CEO of NextBlock Global, which is an investment firm deploying capital into blockchain opportunities. I am the co-author of the book, Blockchain Revolution, which I'm sure many of you know, and I'm delighted to be here today. Ashish, take it from here.
Hey, Ashish Birla, Vice President of Product at Ripple. I've been working in the startup space for the last 20 years, but I'll tell you the last 4 to 5 years at Ripple have been nothing like anything I've experienced before. I think this opportunity in blockchain is a one-in-a-generational opportunity. So I'm excited to speak here today and meet all you guys.
Matt?
Yep. Hi, everyone. My name is Matthew Spoke. I'm the CEO and one of the co-founders of Nuco, Toronto-based blockchain company, building general purpose infrastructure for kind of enterprise applications. Done some work to date, probably most notably a recent announcement with the Toronto Stock Exchange about work we're doing in the natural gas settlement system. So we're more broadly looking at business processes as they impact financial services and other industries. And we're happy to be here. Thanks for having us.
Terrific. So both of you have done a lot of great pioneering work in helping incumbents to understand this technology and working directly with them. And I'd like to start with a question for Ashish, which is that in the many years that you've been doing this, where do you see the opportunities for Ripple's technology to be impactful or very disruptive in the industry?
Yeah, so I've just actually spent 2 to 3 weeks on the road in a lot of emerging markets, and really I think that there's going to be a sea change in terms of how people move money around the world, not only in time and how fast it's going to be using blockchain technology, but also how efficient it's going to be to send even small value payments. And so, you can think of, I was in India and just last week, and how it's really painful for a small, villager to actually receive 100 rupees, which is just a few dollars. But then also think about the future after that, where machines are going to be paying each other, and it may be a fraction of a penny. And that's just not possible today. And that's the kind of change that we're going to need to see, and that's what we're trying to build at Ripple, but also tons of other startups working on in the blockchain space. So I mean, I think that in the short term, it's going to have a big impact on corporations, but also individuals, especially in emerging markets. But then also in the future, the big opportunity I feel is really with machines paying each other.
So right now, the work that you're doing, help us to understand a little bit more about Ripple, because Ripple has a native token XRP, which has a value and it trades out there. But at the same time, I feel like Ripple has de-emphasized the token compared to other platforms like, say, Bitcoin or Ethereum. And I'd say probably in many respects, Ripple's been a real pioneer in working with established entities, banks, settlement systems, clearinghouses, and the like. Can you talk to us a little bit about the experience of working with incumbents? Has it been frustrating? Has it been illuminating? What are the opportunities and challenges there?
Yeah, I mean, so first, I mean, I think we are not de-emphasizing XRP. I mean, that is front and center of our story. I mean, we were so far ahead of the game, I think, in 4 to 5 years ago when we started working with financial institutions. And they've really started to pick up and sort of move forward with everything from cryptography to also XRP, our digital token. So I think it's just sort of a timing thing. The market is absolutely right for that. In terms of working with incumbents, incumbents can be slow, but if you give them a reason to move, they can get live on Ripple in 6 weeks. And so, that's the key is can you show them why this technology is different and how it can bring new business to them? And if you can do that, they'll move in 6 weeks. And so I think there's a reputation of banks being very slow and got the wood paneling inside and the horrible retail experience. But there are a lot of innovative banks out there that are chomping at the bit to reinvent themselves. And so I've been in Silicon Valley for a long time, and I had that impression at the beginning. I'm not a skeptic. I'm a believer in that. Banks can change.
Great. And sorry, I should have clarified or qualified my statement. When I said de-emphasizing, I only meant to say de-emphasizing as a speculative asset, but emphasizing as a tool to change the way you use business, right?
Yeah. Actually, just on that, I mean, I think that's the unique part of Ripple is that we're beyond. We have a token. We believe that this is a very efficient tool to move money and provide liquidity. So I think that we're nailing that use case, and we're out there in the market with that live use case today. So I think that's important.
Great. Matt, over to you. I want to ask you a question. What exactly is blockchain infrastructure? How does that fit into the ecosystem as a whole? And what are the services exactly that you're trying to provide, or the problems that you're trying to solve?
Sure. Yeah, and I think probably the simplest way to explain it is what we consider the difference between a payment solution like a Ripple, for example, or a Bitcoin network versus like a general purpose process automation solution, which is what you could probably consider Ethereum to be. And for context, I sit on the board of directors of the Enterprise Ethereum Alliance. I was one of the early founders of that initiative. And the goal being that there are lots of processes that happen within enterprises, and specifically financial services institutions for this context, that are not payments related. They're updates in process, they're updates in information. In many cases, these updates of information, what we call state changes on a blockchain, could trigger actions. They can trigger something else happening. So, whether it's an update to a client's record that then updates some sort of insurance policy that then eventually triggers a payment, it's how do you record all of these updates in state of information such that you can track and record all of this on a consistent ledger. So what we build essentially is the ability for organizations to create these networks, to create within an industry, within a use case, within a supply chain, create these networks that allow them to coordinate. So you might consider this we coined the term early on of like an enterprise Ethereum network. What we're working on moving forward is how do these networks then kind of interoperate with each other? So we're very bought into the fact that there will be many, many blockchains that get built by industry, by geography, by use case. And then at some point, processes are going to have to traverse blockchains. So I might have an update of information in a healthcare blockchain that eventually triggers a payment in a financial services blockchain. So that's where we're focusing is the creation of these networks and then the interoperability between these networks so that you can have kind of this seamless flow of information without the need for intermediaries to get involved too heavily.
Ashish, I saw you nodding in approval when Matt said that there will be multiple blockchains out there. And yeah, it's easy to imagine there being, movement of value, a payment happening on Ripple, but it entering into a smart contract that's built on Ethereum that runs through the infrastructure that Matt might be building, for example. So what are the solutions? I'll let maybe Ashish, you can give it a shot here, and then Matt, throw it back to you. What needs to be done to make this technology work at scale, and for these different platforms or silos to interoperate with each other in a way that can actually be used to address real large business problems like, say, cross-border settlement or securities trading or something like that?
Yeah, I mean, I was nodding because I actually absolutely believe what Matt said, is that there are going to be different blockchains with different use cases, and just like the automotive industry. I mean, it started with one car, the Model T, but then you saw different models sort of come out there that specialize in different things, and that market was massive. And just like the blockchain market, it's going to be absolutely massive. So one of the technologies that Ripple is sponsoring is the Interledger protocol and ILP, if you guys have heard of that. And what we're aiming to do there is to make all the blockchains out there interoperate. So you have the Ripple blockchain, but you also have Ethereum, and I think every day there's probably 3 or 4 more that are coming out. But some of these are going to be winners, and the key is going to be, like, we don't want to create other silos. We want to create something like the internet where they all interoperate. And so I think that that's why we developed the Interledger protocol. We don't believe that there's going to be one blockchain that takes everything and takes the entire market.
Great. So Matt, why don't you tell us a little bit about two things. Number one, you've got this project with TMX. I'd like to hear more about that to help people make it real. Want to understand how exactly things work today and the way in which your technology is changing the way things are going to work in the future. And then more broadly, to discuss some of the specific opportunities that you see within financial services. What are the areas that you think are going to be the most transformed by this?
Sure, yeah, and so I'll start on the Toronto Stock Exchange. For those of you not familiar with the project, we're working with a subsidiary business that they operate called the Natural Gas Exchange. We've been building essentially a natural gas settlement system. And this kind of goes back to the idea of why are we building dedicated networks? And to Ashish's comment earlier, or maybe it was you, Alex, the idea that if you build too many of these private blockchains without the view on how do they connect to each other, you're just building kind of a new version of a siloed system. You're building a siloed system by industry or by use case. So in its first iteration, that's helpful. I mean, what we can do on a private blockchain today is we can definitely drive a significant amount of efficiency from a traditional process. You say, hey, there's an inefficiency because of reconciliation of records. There's an inefficiency because everybody's maintaining their own copy of stuff rather than agreeing on a single source of truth. So that's what we worked on with the TMX, was how do you solve that inefficiency? And in this context, the record that we're talking about is the actual physical flow of natural gas from producer to buyer, the role of the exchange in guaranteeing that process, and the role of the regulator in actually seeing that information in real time so that you can reduce a compliance requirement on the back end of the process. So there it's just stitching everybody together so that you're always looking at the same constant view of information. Where we want to take the TMX and other clients kind of in this industry is essentially to the more transformative end goal. And the transformative end goal is actually, how do they redefine their role in the market? Their role in the market today is very much the intermediary. They play the role of the record keeper and the transaction processor, right? So if you go to a maybe 5-year out future where depository systems are being rebuilt on distributed networks, then what's the role of the TMX? And the simple example that we've been walking through with them is if you wanted to trade, let's say, from natural gas into another asset class like crude oil, today that always clears through dollars. It clears through the clearinghouse. But in the future, you can imagine that natural gas and crude oil become their own versions of asset-backed digital currencies that can trade directly for one another. And that's where you start seeing that there might be a network created around an asset like natural gas, another network created around an asset like crude oil, and then the ability to use a protocol like ILP, or there's a few other protocols getting developed of a similar kind of nature where I can directly trade one for the other, even if they're not on the same blockchain. And that's where the role of the exchange will change. The analogy we've been using with them is we've kind of tied it back to what happened to media companies in the early 90s when the internet started coming out is you had the ability to, one, your business model got challenged that you could not just be a paper print newspaper, but you got this opportunity to become globally relevant. So the Wall Street Journal took advantage of this, became the global newspaper, not the New York newspaper. And I think we're operating on the assumption that exchanges, as a simple example, can do that too. Their business model might change, but they have the ability to jump to global relevance very quickly when they used to be domestically built and built around specific geographies. So they're buying into that. I think it's a journey because it's a very transformative message, but we've been getting good reception on that.
So it's a very interesting point that you made. A couple of points there. One is about the tokenization of physical assets so that they can move seamlessly peer-to-peer and instantly. And we've seen tokens in the past be transformative, cryptocurrencies first among them, XRP, a great example. Something very interesting, though, has been happening over the past year, which I'm sure a lot of people on this webinar are aware of. And if they're not, I'm going to just give you a quick rundown, which is that new opportunities, new projects, new companies, however you want to define them in the blockchain space, are no longer going to traditional venture capitalists to raise money because they don't have to. They can sell a token, a digital asset that represents some form of value in what they're building, whether it's access or ownership. It can really depend. But the point is that in the process, they're raising enormous amounts of money. And we said in the book that in 5 years, the financial services industry would be unrecognizable. At least when it comes to VC, we were only half right. We were wrong by 4 years. And just in the past 6 months, the amount of money that's been raised through this process, dubbed a so-called ICO, has tripled the amount of money raised through traditional VC. So it makes you wonder if the world of venture capital can be transformed so quickly in such a short period of time, what else out there could be transformed? And are we underestimating or overestimating how long it's going to take for those other parts of the industry to see the kind of cataclysmic change that we've already seen in VC? Ashish, why don't you take that one?
Yeah, just on the VC side, there's VCs provide capital, but they also, provide a network for you to, for early startups to bounce ideas off of or get partnerships going. And I know at Ripple, our VC relationships have been instrumental in terms of opening doors for us. So a little concerned that it's a one-to-one comparison, but
so can I just interrupt quickly, which is to say, does that mean, so I'm personally concerned about groups of people getting access to hundreds of millions of dollars with no adult supervision, or no partners, as you say, to help them understand how to build a business, how to scale technology, how to hire a team, how to implement an HR and other professional systems. So I guess the question is, if capital is accessible now because of this distributed system that's been built, does the role of the VC change? Like, let's maybe focus on VC for a second. Is it because the advice and the counsel may be more important now than ever for a lot of these groups, even if the capital equation could be undergoing this big transformation? I wonder what your thoughts are on that.
That's absolutely accurate. VCs are going to have to reinvent themselves. So maybe they are sort of auditors on different ICOs going forward. You already see that. You see that some VCs are backing some ICOs and putting their name behind that, and maybe that's where the shakeout will happen down the road. But for Ripple, we were lucky. We had a very, very experienced founder that that was careful along the way that we wouldn't burn our capital. And I am concerned that if you look at the track record of startups that have raised $100 million or $20 million seed rounds in San Francisco or the Bay Area, they have not been that successful. It's a lot of slog to get a product that has product market fit out there. And throwing $50 million at the problem isn't a great solution. So definitely, I think that there's going to be a reinvention of the venture capitalists.
I was going to say, I think there's a good reason that VCs and investors tend to like a story of a company that comes from a lean and almost bootstrapped origin, because it forces a certain amount of discipline on the way you approach your technology development and the way you approach identifying your market opportunity. The moment you throw into a half-baked idea an enormous amount of capital, you can almost guarantee that it's going to be poorly spent, and it's going to be misallocated. And not to say that there's no validity behind some of these ideas. I think some of them are very transformative and they could end up being very impactful. But it is concerning that there's no accountability or discipline getting kind of baked into these models. And we'll see where that takes us. But yesterday we set a new record in the industry with $270 million being the new record for a nice deal. And I can't imagine how that gets spent efficiently by a company that is relatively untested. You need to give an opportunity for credibility to be tested, and that's not the case for a lot of these.
Great. So just a quick reminder: we're now going to open it up for questions. People can ask anytime they want in text, and then I'll go through them and ask them from there. But to get things started, Ashish, you mentioned at the beginning that one of the things that really interests you is the intersection of blockchain and the Internet of Things. The idea that in the future, if there are hundreds of billions, if not trillions of devices, a lot of payments might not actually move between person to person or business to business, but could actually move machine to machine. And this is one of the objectives of the Blockchain Research Institute, which is to try and understand how technologies like blockchain are making the boundaries between certain industries more porous, where financial services companies traditionally may not have thought about enabling payment systems for the Internet of Things, but now they have to start thinking about it. Can you spend a little bit of time just kind of doing a little exposition on that idea of blockchain and the IoT? Talk about some of the business opportunities and maybe some of the technical challenges, because micropayments were one of those opportunities that people were quite excited about with Bitcoin. But of course, that network is really not able to support that anymore. Ripple's different. Tell us how.
Yeah, so I think you need tons of scale to make micropayments happen. And so the Ripple ledger, the Ripple consensus ledger, the XRP ledger does over 1,000 transactions per second. The actual fees are a fraction of a penny for each transaction. So the economics of that, we built that ledger specifically for micropayments and payments of all sizes. So I think that was from the genesis of Ripple. That's what we aim to do. Now, in terms of like Internet of Things, I mean, we look out into the future, and you look at if you walk down to the streets of San Francisco today, you'll see tons of automated automobiles and food delivery systems, and right now there are individual companies operating each one of these. But the way that industry is moving is automation and fleet management. And when you have fleets of automated transportation machines out there, they need to interoperate and pay and receive and exchange with other machines out there. So I think, even in transportation, I can see massive changes in terms of how the different machines out there interact with each other and receive and send payments. So I mean, that's just one example that I'm pretty passionate about in terms of how Internet of Things is going to transform the transportation industry.
Matt, any other examples you can think of how financial services is crossing over into some of these other industries because of the rise of technologies like blockchain, like automation, like robotics and the rest?
Well, the one comment I'll make is that we've taken the view that blockchains are essentially they're eliminating the barriers that used to exist between industries. So we stopped looking at things from like a financial services versus insurance versus healthcare versus IoT perspective, and we realized that these things are going to be a lot more, right? So an IoT device that's involved in maintaining or tracking some sort of health behavior that triggers some sort of insurance policy to a payment is one use case, right? And the ability to stitch that all together is where you really drive to the end goal and the end potential of this technology, so that you're not having to jump through groups of intermediaries along the way. And one of our views on this is that for us to achieve that kind of scale, because when we say a transaction, we mean a very different thing than in the context of a payment system, right? We mean an update of information. So an update of information can be the change of ownership of an asset, but it can also be something significantly more simple, like the update of information to somebody's medical record. That's a transaction on a blockchain that requires scale. So for us, the concept around transactions being more broadly defined means that scale requires, probably at some point, hundreds of thousands, if not millions of transactions per second collectively our base assumption is one network will not be able to manage that. You're going to need many networks built for these purposes. And then going back again, how do you connect these processes across networks through an ILP type protocol? That's where we see financial services starting to become relevant kind of all over the place. It really becomes an embedded portion of everything you do in your life, where the payment just becomes inherent and doesn't become like the forefront of an application. It just happens on the back end of an application.
That's a really interesting point. Oftentimes you hear incumbents talking about blockchain, and I think it falls into sort of one of three categories. The first one is that a lot of them understand that this could be disruptive, but maybe they're not as familiar with it, and so they're a little bit apprehensive, maybe even scared. I think increasingly more and more groups are looking at it, though, in the latter category, the second category, which is to say this technology actually offers an opportunity to significantly reduce the complexity and friction of my own business, and as a result could save me a tremendous amount of money by automating or streamlining existing processes. And then there's a third category who are saying, well, that might be true, but if my industry changes in a fundamental way, then there may not be any cost to cut because the structure of that marketplace might be different. So you see examples of consulting firms and the like saying a certain number of billions of dollars could be cut from the market for public equities. But as you rightly pointed out, Matt, if assets are all digital, so to speak, and that they can be traded in a decentralized exchange, and that whoever bears them owns them, and we don't need clearing and settling systems, then there isn't a public equity market, so to speak, to cut cost from. So in that third category, I think a lot of groups are looking at it strategically, which is the points that you've both made, which is how does this technology maybe enable me to do something I couldn't do before? How does it enable me to rethink my role in the market, or build new products and services, or enter new industries because the boundaries between these industries are changing a lot. So it's all very exciting, but there are lots of implementation challenges to making this happen, and that's what I'd like to spend some time on now. The first one, and one I think that comes up quite rightly and quite fairly, is what is the role of regulations in all of this? How do we get from A to B in a way that is, enables the technology to reach its potential, while also doing so in a responsible regulatory framework, if those two are even reconcilable? So I'd like to maybe ask you, Matt, to kick things off. Sure.
Yeah, and we've had a lot of discussions about this. I mean, I sit as an advisor to the Ontario Securities Commission, which is, I guess, our equivalent of the SEC in Toronto. And the concept of regulations around these public markets has become a big topic of conversation, specifically the ICO kind of hype that's happening right now. So in that context, there's a big challenge being put in front of regulators, and I'm not sure what the answer is, quite frankly. I think there's going to become a realization that there are certain things that may fall outside of the control of what regulators can actually enforce, and that's a big challenge for them to wrap their head around. But more broadly, the way we're, again, going back to what we do in the market is building these systems for particular industries. I think the long-term potential is actually baking in regulations into the design of the system, meaning that regulations become an automated part of the software rather than a compliance process after. And that means, from a government's perspective, from a regulator's perspective, I think they should be looking at this technology as how do I drive myself out of relevance? And and to a business that sounds kind of threatening, but to a regulator or to a government that should sound like, hey, if I can automate this process such that I more effectively oversee a market, and I don't need armies and armies of people to do that, that should be like a positive outcome, right? So I think what you can do is when you start creating these new asset markets, you start creating these processes by dedicating kind of customized infrastructure and customized networks in which regulators can have a say in the design of these systems. You can make sure that compliance is enforced at the moment of transaction rather than enforced as an afterthought. And that's really, really compelling, and I think regulators are starting to realize that.
So rather than something to be afraid of, maybe blockchain could actually be a powerful tool for them to perform their role as of oversight and of investor protection a bit more effectively, essentially. Yeah. Ashish, you're operating in some different markets than Matt is, cross-border payments, interacting with groups like SWIFT and the like. What's that experience been like, and how's your relationship with the regulators evolved over time?
Yeah, so our founder has been in the fintech space for a number of years, and so early on in our culture, we've been really active in terms of working with regulators. So we just completed a pilot with the Central Bank of England in March. And our approach has been show them how they can benefit from this technology. And so, we were out in India working with government agencies there. Again, I mean, the regulators have to see how this technology can be used to improve transparency. And then also, maybe it's not just a domestic system for central banks anymore. Maybe they're facilitating a more efficient way to move capital across the world, because it is a global economy after all. So, we have a lot of luck and sort of a lot of experience working with not only central banks but regulators in general as well. We're also part of the Fed's Faster Payments Task Force, and then a member of the IMF FinTech Advisory Group as well. So we are very well staffed and represented.
Terrific. So on the question of challenges, things that need to be overcome, we've spoken a little bit about not something to be overcome, but the challenge of how does regulation fit into this new industry is one. Ashish, you talked a little bit about scalability, as did Matt, about how do we actually scale this technology to meet the demands that ultimately will be placed on it, millions of transactions a second in a connected Internet of Things environment. One other thing that's come up, and this is a question from one of the members of the webinar, which is, how does quantum computing affect the immutability, security, et cetera, of blockchain systems? Is it something that poses a threat, or is it something that could actually be harnessed to make this even more secure? And I don't know who wants to answer that one.
I don't mind taking a quick stab at that, and I
Sure.
won't profess to be an expert in quantum computing. It's an area of concern for a lot of system providers out there, not just blockchains. But there is a lot of research being done, and I think what's really compelling about our industry particularly is that a lot of this research is being done out in the open, meaning we can all take advantage of some of the outcomes. There has been some research done around how do you take the concept of a quantum key distribution system and what's called post-quantum cryptography and embed that into how you're designing these systems, so that at the very least you can create a more resistant environment to quantum threats. The challenge with quantum computing is we don't know to the extent in which it will come to reality, right? We're seeing very, very early indications of what quantum computing might be able to do. A lot of it is still theoretical. So until we actually have, real quantum power to throw at these networks, it's going to be more theoretical than anything. But there is research being done on quantum resistance for just general public-private key systems, which include a lot of blockchains today.
So we've got another question, and I think this is actually an interesting one because it's sort of elemental to all of this. The question is, what is the difference between all of these different currencies? But I think a better way to sort of rephrase that would be to say, what is the difference between all these different kinds of technologies, essentially? Bitcoin was designed as a single-purpose technology. It was designed as digital cash, a way to move value peer-to-peer without going through an intermediary. Ethereum was designed as was supposed to be a global computer built on this notion of smart contracting, so that you could program any kind of business logic into a transaction, and from there even build distributed applications on top of it. We've heard a little bit about Ripple. So that's 3. There are 850 others in 10 words or less. What do those other 850 things do?
Do you want to go ahead, Ashish? I mean, I have an opinion that I use the term digital barter system, and I think what we're seeing is that these currencies are being built around a utility, and that and in some cases that utility is payments, like Bitcoin.
Your 10 words are up.
Okay, so
no, I'm just kidding. Digital bearer instruments.
Yeah, and I mean, you can see this by certain, especially you look into the ICO market and you notice that a lot of the coins that are being built, these so-called coins, are being built around single functionalities. So, a good example is storage, or Storj, some people call it. Storage is a payment system that is specifically used to buy storage. It's a single purpose payment system. And we're starting to see that that's becoming very common. And it used to be an inefficient way to transact, but now when you create digital versions of these things, it's actually pretty efficient. So you can create, Gollum is a digital token system to buy computing power.
Yeah.
Storage. So like this digital barter concept, I think, is going to become pretty prominent, where you can create asset-to-asset exchanges where you don't need to go through currencies all the time.
I think just one thing is that, I'm a big fan of of folks that like pick a sort of vertical or a use case and become really good at that for their blockchain. So I think, we took that approach. It's working well for us. I will say that what folks are going to realize is that tech is only a small percentage of the problem that you have to solve as a company. And so, we talked about regulation, but you also have to talk about standards and network agreements and so forth. Those are very complex, because if you want interoperability, you have to have standards, and you have to bring these different companies, whether it's insurance companies or banks or central banks, together to agree on that standard, and that's pretty difficult. So so while I'm all for different use cases and different blockchain platforms, I think folks right now are underestimating how much of this is a tech challenge versus everything else on top of that.
You're muted.
Addendum to it, which is there are things that are not coins or currencies, so to speak. There are projects like Hyperledger, which is an initiative of the Linux Foundation, which is doing things similar, I guess, to what a lot of these other projects are doing, where they're looking at solutions for the enterprise as well. Another question from the audience, what about collaborative lending? That's never really taken off, notwithstanding some sort of P2P lending platforms. Will blockchain change that? And I think that's a good way to talk about a few things. So let's talk about collaborative models more generally. So how do we connect people within the crowd in these distributed systems without intermediaries? And also, what does this maybe mean for the folks in the world who just don't have access to financial services? Ashish touched on that idea of inclusion earlier on. Let's kind of unbundle that one a little bit. Ashish, do you want to kick things off?
Yeah, so I think that what's great about blockchain technology is that it improves access. And today, if you wanted to open a bank account, think about all the different things that you need to have a bank account. You need identity, you need credit score, you need capital, and so forth. So in places in Africa and India and a lot of Southeast Asia, we've seen blockchain applied to the underbanked. And you look at BitPesa and how they've been successful into Africa. So I think that's near and dear to my heart, and I definitely feel like that is a big change. And again, I'll go back to that example. We were meeting with a lot of telcos in India that are now enabling their customers to receive 100 rupee payment, and that could never be done before, because listen, if you use Swift, you're gonna get charged $40 for one wire, and 100 rupee payment is less than $2. So I think that is an absolute immediate use case that we're going to see adopted for a lot of the emerging market to get going with. So,
Matt, you want to touch on the collaborative model part of that question?
Yeah, and I think that lending and even crowdfunding being two good examples. To Ashish's point is, right now there's a certain minimum threshold underneath which it no longer makes sense to participate in a crowdfunding platform or like a peer-to-peer lending platform, because the payment process associated with lending or crowdfunding will charge you more than the value of what you're trying to lend or fund. So whether that's Kickstarter or any type of like equity crowdfunding, there's a threshold under which the credit card transaction fee kills the opportunity to participate. And I think if you want to go to scale, and this is why equity crowdfunding in Canada, at least, and I think in the US as well, it started to become a topic of discussion around regulators. They've started to allow it in certain contexts, but as far as I can tell, it's been a pretty big failure in terms of its adoption. There's not been an enormous amount of people putting money into these equity crowdfunding platforms because there's frictions in the process, and it's difficult to do easy payments through this process. So if the ICO market is teaching us anything, is that you can accept payments as little as a penny and as large as $1 million as easily, right? And that's not true on a peer-to-peer lending platform or a crowdfunding platform today. And I think especially as you go into the developing world, where the values of these transactions are smaller and smaller and smaller, you essentially start you start cutting people out of the process. You start excluding people from the ability to participate in these new economies, and I think this can be pretty transformative there.
Yeah, just to add to that point, I mean, one thing that people don't realize about the peer-to-peer lending market today is that it started off as being like, hey, you can raise money from anyone, but what folks realize is that there's not enough capital, like to the point Matt brought up, to raise enough money from friends and family or average citizens. So the peer-to-peer lending market is now back where it started. So it's raising money from banks and from hedge funds. So I think, again, like, what we've learned from the ICO market is that, wow, it's really easy, good and bad, to raise money from all places around the world, Japan, Korea, the US, and so forth. And so that access to capital is a key problem that's being solved. So I'm actually pretty bullish to see how that model is applied to peer-to-peer lending, because I really feel like the core problem in peer-to-peer lending was access to capital and not so much, a tech problem or anything like that.
Ashish, we've got about 5 minutes left, but you brought up one thing I think is kind of foundational to all of this, which is identity. So one of the big reasons you said that people in the developing world don't have access to financial services is because they lack an identity in many respects. They don't have a way to prove who they are. And without that, KYC, AML follows from that. That's very difficult to achieve. But in the same way, for people who are in the developed world, you do have a digital identity, except it doesn't belong to you, or it's not controlled by you. It's fragmented and spread across the internet and held captive by a bunch of these different intermediaries. So two-part question: how does blockchain, number one, make it easier for people who don't have an identity to establish one? And number two, how should we think about will identity evolve to a point where it's something that is sovereign to the individual, controlled by them, or is it going to continue to exist as this thing that's sort of spread out across different intermediaries? And then from there, what is impact, if any, does that have on financial services? How banks onboard customers, do KYC, how they interact with them, how they get data from them, et cetera. It's kind of a big question, but if you could just spend a minute on identity each, that'd be helpful.
Yes, I mean, early on at Ripple, maybe 4 years ago, we did experiment with a digital identity system, and I think it's going to be a series of phases, and I don't think we're very close to a global identification system on the blockchain. And I think the model to look at is actually, if you guys are familiar with India's model called Aadhaar, or the India Stack, where the government has basically mandated everyone to get a digital identity. And that has, again, transformed, how easy it is to get a bank account. They've done a really good job there. And so I think that is the model in phase one, at least, for a digital identity system, is having it sponsored by a local government. If a private corporation tries to do it, it's like, why would any other corporation want to give up your identity details to a private entity? And if it's global, then the local governments have to sort of buy into it. So I really think that the first phase is you gotta look at countries like India that I think are doing it really well with the national identification system. And then phase two would be, all right, can we get the different countries together to agree on something maybe that's on the blockchain, but it's more global based.
Okay, sounds like there might be some challenges to making that happen. So one more question. Which is, for the folks who are listening in on this, some of them are probably, my guess is, at different levels of their journey in this space. For those who haven't yet made a move in one direction or the other, what advice would you provide in helping to understand and to engage with this technology and to actually implement it to affect change? And you can say, call me after so we can have a conversation about Ripple or Nuco. It's got to be something, or maybe that is your advice. But what big initiatives should people be pursuing, or what steps can they take?
My perspective is, look beyond the immediate obvious applicability of like just an efficiency driving use case today. And I think the one thing that I heard, I was at a conference last week and I heard this analogy of zoom in and zoom out. And the concept of zoom in and zoom out was very simply like zoom out to the point where you can see 10 years into the future or 20 years into the future and ask yourself, is your business still going to play the role that it plays today in 10 or 20 years? And you take parallels into other industries and you see like, automotive companies have had to zoom out and realize that they will not play the same role in 20 years. So what do they have to do today to start adjusting to that? And I think that's relevant in most industries. If you zoom out and really start to fundamentally ask, is somebody going to pay me for what I currently provide to the market today in 20 years? And a lot of businesses will be challenged to say yes to that question. And if the answer to that question is no, then zoom back in and figure out, what do I need to do over the next 6 months, 1 year? And in many cases, it's starting to experiment with technologies. I don't think it's enough to just start dabbling around with proof of concepts. I think that's kind of, getting a little bit beyond relevance. every bank in the world has done some great experiments with Ripple, and I think Ripple's now starting to, I won't speak for you, Ashish, but starting to push people kind of beyond just experimentation, and same thing with us. So, that's the one thing I would say is figure out, is my business model going to change? How is this technology going to allow me to be relevant in the future? And then experiment on that hypothesis.
Yeah, Matt, really well said. So, I mean, we learned this early on. If your customers are thinking about your technology or using your technology to become more efficient, it's not worth your time. And no one spends, no one tries to transform their company to save 10% on their bottom line. So 100%, the technology or the use cases you're going after have to be, they could be small today, but they're going to be massive tomorrow. So think about that 5 to 10 years out, as Matt was saying, that whatever use cases you're going after are going to be massive then. The second thing is, like, don't fool yourself. The technology is really cool. It's novel. It's innovative. But you got to go back to basics, and you got to solve a real business problem. And it doesn't have to be massive today. Again, it could be something that's growing. But don't fool yourself thinking that technology is like a panacea out there that's going to solve everything.
Great closing remarks, and I'll add to that the best thing you can do is to start now, because it's very likely that the next generation of technology innovation is going to happen faster than the previous one, because the conditions exist for it to happen faster. The first generation of the internet, there were 25 million PCs and about as many connections to the ARPANET. Today, 2/3 of the world's population owns a supercomputer. So the expectation should be that things will happen faster. So start right away. I'd like to thank both Ashish and Matt for a terrific conversation. To all of you who joined us for this hour to participate alongside. This, as I mentioned, is the first webinar of many that we're going to be doing. We'll be running them on a monthly basis, and we are going to be announcing the next one within the next couple of weeks. And I should add also that many of the issues that you heard today, where we really just grazed the surface, are ones where we're going to be exploring in much greater detail when the time comes in all of our research reports. So for those of you who are members of the program, we're delighted to have you on board. And for those who are not, please get in contact with us to learn more. And with that, we will end things. Everyone have a lovely day and take care. Thanks a lot.
Thank you.